Well guys, here today I want to take you through shorting stocks. I want to talk about if you should be shorting stocks now, if that's a smart decision. Shorting stocks, a lot of people kind of hear about it. Oh, shorting shares. Is that something I should get into? Is that something I should be interested in? Is there something smarter I could do out there? And so I want to give you my full opinion around short selling stocks. Now, if you don't really know what short selling a stock means, essentially you're betting that a stock will go down in price. So think about it in the traditional respect of like if you buy Apple stock, right? Or you buy Facebook stock, you buy Google stock, or whatever stock it is, right? You're basically placing a bet that you believe those shares are going to increase in value over time, or hopefully they'll pay you a bunch of dividend money or something like that. But generally, if you're buying Apple stock, for instance, it's because you believe the stock price will go up over time, okay? A short position, when you go short shares, you're literally just doing the inverse. You're basically making a bet that you believe that stock will decrease in value over the coming weeks, months, or years, or whatever, depending on your circumstance and however long out your kind of respect is in regards to shorting that stock, all right? So in the simplest terms, that's what shorting a stock is, okay? Now, when you short, you're borrowing shares from a brokerage, okay, that you're going to go ahead and buy back at some point in time. The difference between when you shorted those shares and what you buy those shares back for, that is what your profit or loss is. And you could do that at any point in time, okay? So you could go in, tomorrow and go ahead and short, we'll just use Apple stock. Everybody knows Apple stock, right? You go ahead and short sell Apple stock tomorrow, for instance, from your brokerage, as long as you have a margin account set up, okay? You usually have to have a margin account set up through your brokerage in order to short shares. So you go ahead and short Apple stock tomorrow because you believe Apple stock's going to go down tomorrow. And then you can go ahead and buy back those shares, the same shares you shorted, let's say you short 10 Apple shares tomorrow, you go buy them back tomorrow if you want it. And the difference between what you shorted those shares at and what you go ahead and bought those shares back for, that's going to be the difference in what you lost or made on that investment, okay? And you could do that for, the day or the week or the month or years in the future. It really doesn't matter at the end of the day, okay? So let's go through a couple scenarios here. So if you short a stock, you short stock ABC, and let's say that stock's $100 a share, all right? If that stock goes to $150 a share and you go ahead and buy back those shares, you cover your short position as it's called, okay? You go ahead and buy back those shares, you cover your short position, you get out of that, you just lost $50 per share because the stock went up in price, okay? Now, if you were long that stock, obviously you're doing very well, but when you're short, that's not such a good thing, okay? But let's say that stock does go your way. The stock has a really hard time, they have some bad earnings, whatever happens, okay? Let's say that stock falls 50%, goes all the way down to $50 a share. Now we're in a situation where you just gained $50 per share, okay? So obviously, if you short a stock, you need it to go your way. No different than if you're long, you need the stock to usually go up over time, okay? Now keep in mind, with going long shares, some companies pay dividends, so sometimes you can make dividend money still, which even if the stock doesn't go up, you at least get dividend money. With shorting shares, there's no dividend money for you or something like that, okay? So if you're shorting shares, like you're just counting on basically the stock price going down over time, all right? So now let's say the best case scenario happens possible. What is the best case scenario that if you shorted stock A, B, and C? Well, that'd be the stock goes to literally $0 a share, okay? It goes from $100 where you started shorting it at, and when you go to cover, it's at zero. It like literally went bankrupt or something like that. That would be the best case scenario possible for you. And in that situation, you make 100% return on your investment. So when you go ahead and short a stock, essentially, the best case scenario you can have happen for you is you make 100% on that stock, all right? And that, once again, that means the stock literally went to zero and you got your 100% gain, okay? Now, you got to keep a couple things in mind. And keep in mind, these couple things I'm going to share with you, this is not even the worst part of this. We're actually going to get into the worst part in just a second, okay? Couple things to keep in mind here. Number one, the loss is unlimited when you short shares, okay? So for instance, let's say you short stock A, B, and C. Stock A, B, and C can go to $200 a share. Stock A, B, and C can go to $500 a share, $1,000 a share, $10,000 a share, okay? So if you short this stock and things start to go really bad, you could literally lose an unlimited amount of money when you short a stock. You could literally lose an unlimited amount of money. And that is rough, okay? You know, if you go long shares, for instance, okay? If you go long, your loss is limited at 100%, right? You buy this stock at $100 a share, you buy one share, your loss is limited at $100. Because let's say the company goes bankrupt, it goes to zero, you just lost your $100. Okay, now hopefully if you're buying companies that have great balance sheets and are very profitable, that should be very unrealistic, right? But needless to say, basically your loss is capped at 100%. When you short shares, it's literally an unlimited loss. Now, a brokerage could also force you to cover your shares at some point in time if it goes really the wrong way or something like that, and you get into a margin call situation or something like that. Okay, keep in mind you're borrowing the shares at the end of the day. So, you know, it's possible there could be a situation where you are forced to buy back your shares, okay? But needless to say, shorting shares, your potential loss is unlimited, whereas you go long shares, your loss is limited at 100%, okay? Number two, you have to pay interest when you are shorting stocks. You have to pay interest when you are shorting stocks. So if I go long shares, and unless you're going on margin or something like that, but if you have a regular brokerage account and you go buy some shares of a stock today, you go buy some shares of Apple stock, like you don't have to pay interest on that. But when you short shares, you generally always have to pay interest, and that interest rate can be different depending on different stocks. I've seen it 5-10% plus sometimes when you're shorting a specific stock out of there. So which means you got to get at least a 5-10% gain just to break even on what you're paying in interest per year, okay? Never mind, you know, if you're not getting that, then you basically can lose money, plus you had to pay interest in it, so it can get really ugly, okay? Now keep in mind, this is not even the worst part of shorting stocks, okay? This is not even the worst part. Those two things, that the fact that your loss is unlimited and also the fact that you have to pay interest, that's not even the worst part. Let's get into the worst part now. Alrighty guys, let's start getting into the worst parts of being a short seller and why short selling stocks is absolutely usually a horrible idea and usually a very unprofitable endeavor, okay? We already talked about the potential loss is unlimited. We already talked about the potential gain is 100%, which is no fun, okay? Number three, you have to pay interest while you short. We talked about all three of those. Number four, the market goes way up, way more than down, okay? Most years, most weeks, most months, most decades, where does the stock market go? It goes up. Look at any chart you possibly want out there in the S&P 500. Most of the time, the stock market goes up way more than it goes down. Basically meaning if you're shorting stocks or shorting the entire market in general, you're just fighting an uphill battle because you're fighting against the trend, which is a trend. The market goes higher and higher and higher over time. Sometimes it dips for a few weeks, maybe a few months, maybe even a year or two, but over the long term, you just pull up a chart of the S&P 500, the Dow 30, it doesn't really matter, the NASDAQ, and what you'll find is, yeah, sometimes there were some down periods where the market got too overvalued at a particular time, stock prices needed to come down, or there was a big recession or something like that, and in those few instances, you could maybe have, successfully shorted shares, but that's really hard to time the market specifically, or even stocks in general, okay? So you're fighting an uphill battle. Number five, the government wants an increasing stock market, okay? All politicians that are in office, they want the stock market to go where? They want it to go up over time so they can put that on their record. They say, since I became president or since I, got elected to such and such position, the stock market has increased blah, blah, blah percentage or whatever, okay? No one wants to become, a high-ranking official in government and the stock market decreased over the time while they were in office, right? That's obviously not a good sign. So you're fighting, government officials who, at the end of the day, they want the stock market to go up, and they're probably going to do incentives to try to make the stock market go up over time. And, maybe it could even be things done by the Fed, quantitative easing, different programs like that. Needless to say, once again, you're fighting an uphill battle because the government literally wants an increasing stock market over time, okay? Number six, you're fighting executives, a lot of very brilliant individuals that want increasing stock prices of their stock. Why? Because a lot of, executives' compensation packages are tied to their stock price. So if a stock doesn't do good, an executive can still make money. They're still going to make their base salary, but they're probably not going to make much for bonuses. So if an executive really wants to bank money in a big way, which all people do, right? I don't think there's any executive out there that says, oh, I can make an extra $5 million this year, but I don't want to, okay? All executives want to make more money at the end. How do they do that? A lot of them need to have their stock prices increase, so they're going to try to do whatever it takes to have those stock. They're going to try to, make the net income go up to whatever it needs to, so the stock price can increase over time. They're going to try to do buyback shares. They're going to try to, think about different ways of financing deals. They're going to do whatever it takes, acquisitions, so that overall that stock price, because keep in mind, the executives are basically chosen by the board of directors. The board of directors are chosen by the investors of the company. So if the investors of a company are unhappy, they're going to elect new board of directors, which means those board of directors are going to get replaced by somebody else. And the board of directors doesn't want to get replaced. They make their easy $100,000 to $300,000 a year for just coming to a few meetings and deciding these folks. The executives don't want to get replaced. Obviously, they want to keep making their millions of dollars and getting those potential huge payouts there. So needless to say, all these people are fighting for higher stock prices. They're going to do whatever it takes for over time those stock prices to increase so they can make maximum bonuses, okay? Number 7, companies are usually constantly buying back shares. I mean, the most companies I know of, and probably most companies I have actual share buybacks going on right now, okay? This is another reason you're fighting an uphill battle if you're shorting stocks. A company can literally use their profits and plow that money off the balance sheet. They could just plow that money right back into the stock. And then you're fighting an uphill battle of not only could other, basically people that are going long shares be buying the stock, but then the own company could be plowing tens of millions, hundreds of millions, or even billions of dollars into that stock each month or maybe each quarter. And so you're fighting this uphill battle where you're shorting shares, you need the stock to go lower, but you have all these things working against you that basically are going to probably make the stock go up over time, all right? Number 8, if that's not already bad enough, the masses, meaning individuals out there, regular folks, are usually constantly flooding money into their 401ks, their individual retirement accounts. Think about it this way. Imagine, there's a big company and employs, let's say 30,000 people. Let's say not everybody there contributes to their 401k every year. Let's say only half of them do that, okay? And let's say each of them does $100 a month or something like that on average for 15,000 people. Run the numbers on that. That's a big number at the end of the pie, right? That are constantly flooding money. And then think about how many millions, tens of millions of just Americans alone are constantly flooding money into their 401ks or their individual retirement accounts. And usually that's way more in inflow than outflow over the long term. And so it's another reason you're fighting an uphill battle in this game, guys. You're fighting an uphill battle. Then you think about it, people in other countries, a lot of times are trying to invest in 401ks, maybe in Europe or Asian different regions and whatnot. They want to invest in the States. They can do so through 401ks or individual retirement accounts. It's just a massive uphill battle, okay? And number 9, let's say you're really smart short seller and you had this company pegged and you're so smart, okay? You know this stock is insolvent, they're going to go out of business, they're going to become irrelevant, their product was a fad, blah, 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 whatever your reasoning is, okay? And you're like, that stock is going to go down the tubes, okay? And you're like, I'm shorting shares, they're $10 here. And the stock starts to go down, and it goes down to $9, and it goes down to $8, and the prospects for the company are looking worse and worse, and you're like, I'm going to kill it on this one. I'm already up 20% or whatever. Then it goes down to $7, and you're like, oh yes, this company's going out of business, okay? They're going to do so bad. Their numbers keep coming out. Their money's leaving their balance sheet. They're doing so bad. I'm going to make so much. And then one morning you wake up and company XYZ just bought company ABC that you shorted, and they just bought them out for $12 a share. And you just say, now you went from you who thought you were the smartest man in the room, you were going to make so much money, to now literally overnight the company's going to get bought out and you just lost a lot of money on those shares, okay? So that's another reason you're fighting an uphill battle, is the fact that any company can basically get bought out at any time, especially if they're doing bad. And the shareholders will likely approve a buyout if they can get a 30% or 50% premium to their shares. And so you go from a position where, yeah, you were right, that stock probably was going to go out of business. That company probably was going to go out of business. They were probably not going to stop losing money. They were probably, their balance sheet was getting worse and worse. You were probably right. The stock was going to go to zero at some point in time, but it never got there because they got bought out because somebody else saw the ability of that company, or they could stream their products in, bring it to profitability or something like that. Whatever the reasoning is, it doesn't really matter in the end. You just went from oh, you are going to make a lot of money, to literally overnight, you are guaranteed to lose money, okay? So basically, at the end of the day, if you're shorting shares, and then we'll talk about what's a better option, in my personal opinion, than shorting shares, is you're basically fighting against a rigged system against you. The system is rigged 100% to go up over time, okay? Stocks are meant to go up over time. The markets are meant to go up over time. The whole thing is like rigged against you, okay? It's literally, as a, I live in Las Vegas, okay? And needless to say, the casinos, they don't have one single game where they don't have the best odds, okay? It doesn't matter what you go and do at the casino. All the games are rigged more in the house's favor than in your favor as the player, okay? It's just the way it is, okay? Blackjack, craps, it doesn't matter what game it is, the slot machines, it literally doesn't matter. The games are rigged against you, okay? That's how all those massive buildings got built, as they like to say, okay? So if you're shorting stocks, the game is rigged against you, and you're basically fighting an uphill battle that you're trying to win against a rigged game. It's why you see so many short sellers that are so negative all the time or have bad attitudes. And you're like, man, why are they so negative? Like it just doesn't seem like they ever smile, and they're just so unhappy and things like that. And you got to understand, if you had to fight against a system that was rigged against you every day, I would probably walk around with a frown on my. It's like you can either like be on the right side of things, go long shares, and probably make a lot of money over time, or you can try to fight against the system and fight an uphill battle, and you're probably going to lose in the end, okay? And it's just the way it works in this game, okay? So in my personal opinion, the better option out there, no pun intended, is if you are super negative on a stock, or you're super negative on the markets in general, generally the better option is generally to buy put options in a scenario like that. Now the problem with put options is, yeah, you can lose, let's say you buy put options. Here's the good thing about put options. You can lose 100% of your money with a put option. You buy a put option, you open a position and buying a put option, you can lose maximum 100%. Once again, you short shares, you can lose, unlimited amount of money. 2, you don't need to pay interest as long as you're not buying that put option on margin or something like that. You don't have to pay interest. So that's definitely some good things against short position. The downside is short position you can keep, open for an unlimited amount of time, essentially. A put option, you do have to put a time frame on it. So either like next week or a few months from now, or like a year from now or 2 years from now. Usually like 2 years out is usually the furthest out. You can either buy call options or buy put options. Obviously, if you're going negative, usually the scenario is buy put options. And it's usually a way better option because you can usually do that with way less capital. And then keep in mind, you're capping your loss at 100%. So let's say you buy $1,000 in put options on stock, ABC here. Okay, your potential loss is $1,000. Let's say the stock goes up and your options expire worthless. You just lost $1,000, but that's the most you can lose if you bought the puts. If you short shares and you put, let's say $10,000 into that because you want, the equivalent, chance of kind of making money. Now your potential is actually way more than $10,000. You could lose the $10,000, but you could lose way more than that because the stock could go up way higher than that, essentially. So in my personal opinion, if I'm negative on a stock or I'm negative on the markets in general, what I go to is I buy put options, okay? And I haven't bought put options in a while. I bought put options on Ford a few years ago. I made good money on that. I think I made 20 or 30% in like a month or two's time. And that's honestly the last time I did that. That might have been, 2 or 3 years ago for all I matter. Like that was quite a while ago. I usually don't do it very often. But if I see a scenario where I'm like, I see this stock and I'm like, I'm negative on it and I have a good, kind of bearish thesis around it, I'm going to buy put options in it, okay? And that's just the way it is. Shorting shares, that's way too tough of a fight. And just being negative on stocks or negative on the market in general is way too tough of a fight. There's so many things that are working against you constantly that it's like a never-ending struggle, and it's why, it's not a healthy way to live, man. Being a short seller and shorting stocks is not a healthy way to live. It is no fun. You get those few like short bursts of fun, kind of like, you go to a casino and you might pull the slot and you might win once, right? Or you might play some blackjack and you might win a few hands and you're like, dang, you get that short burst. But guess what happens over the long term? Generally, it's not going to go your way because you're fighting a rigged game against you, and that's no fun to do on an everyday basis, guys. So, my opinion, shorting stocks, absolutely not a good decision. Usually, in most, almost all scenarios, if I'm going to do something because I'm negative, I'm buying put options. That's me personally. I want to hear from you guys in the comment section. As always, let me know your opinion down there. As always, thank you for watching and have a great day.